Mother Nature has always given us everything, all the resources to live and thrive, always natural.
Let me briefly describe about Spritzer. Spritzer is a Malaysian brand established in 1989 by Datuk Lim Kok Siong. It is headquartered in Perak, Malaysia. Spritzer offers various products including mineral water, sparkling water, distilled water, flavored drinks, and packaging products under brand like Spritzer, Cactus, Desa, Summer and Asilis. Their water is sourced from protected rainforests in Taipei. Additionally, the company is involved in investment and property holding. Capital structure refers to the mix of various sources of funds that the company uses to finance its operations and growth. This mix typically includes equity, which is fundraised by issuing shares, and debt, which is borrowed funds that must be repaid with interest. There are some advantages and disadvantages in capital structure. Some of the advantages are optimal capital cost, enhanced financial flexibility by referring the ratio calculation, improved shareholder values, and it helps balancing the risk and return. For disadvantages, capital structure may increase financial risks because it is contain debt, higher interest costs, and diluted ownership control. Capital structure analysis for 2023 for Spritzer shows that it is extremely low. Debt ratio indicates that the company has very little debt in relation to its total asset, where the debt ratio in 2023 was 0.23%. Meanwhile, low debt to equity ratio shows that the company is primarily financial through equity rather than debt, where the debt equity ratio in 2023 was 0.31%. And lastly, a high equity ratio of 0.77 means that 77% of the company's assets are financed by equity.
Dividend policy is the company's decision on how to share profit with shareholders, either as a cash dividend or shares. In this slide, we have three advantages of a dividend policy. First, attract investors with consistent return. Second, show that the company is financially stable. Third, help reduce the cost of capital by attracting long-term investors. However, there are also some disadvantages. First, limit funds available for growth and investment. Second, dividends are taxed, making them less efficient financially. Third, the company reputation may suffer if dividends are reduced. In 2023, Spritzer BORHAN announced a dividend of 5.5 cents per share, which is a 32% increase compared to 2022. This dividend result is a payout ratio of 35%, meaning that 35% of the company net profit is paid out as dividend to shareholders, while the rest is reinvestment for growth.
Moving on to the impact of different financing options. Firstly is the debt financings. The advantages of debt financing is interest payments are tax deductible, does not dilute the ownerships, payment schedule fixed to help financial planning, and the disadvantages is must make regular interest payments and repay principals. High levels of debt increase financial leverage and risk, and too much debt give negative impact to companies' credit rating. Secondly is the equity financings. Advantages of equity financings is not require repayment and no obligatory interest payment, reduce risk of financial distress, and reinvesting profit and fund raised through equity. For the disadvantages is reduced percentage of ownership and can be more expensive in the long term. Lastly is a hybrid financings. The advantages of hybrid financing is combine both debt and equity, appealing to target the investor who seek a blend of security and potential upside. And usually hybrid have lower cost of capitals. And disadvantages of hybrid financing is more complex to manage and understand, might involve interest of or dividend payment depending on instrument taken, and perceived negatively when issuing hybrid instrument by the market. Next is a recommendation of optimal of capital structure. Balanced mix of debt and equity. Maintain a manageable debt to equity ratio to benefit from tax advantages of debt while minimizing financial risks. Secondly is utilize hybrid instrument. Use instruments like convertible bonds and preferred shares to lower the cost of capital and attract diverse investors. And lastly is maintain financial flexibility. Keep sufficient cash reserved to manage unexpected expenses and seize investment opportunities.
Recommendation of dividend policy. First is consistent dividend payment. It is target a dividend payout ratio of 30% to 50%, balancing shareholder rewards and return earnings for growth. Second is attractive dividend yield. It is provide a sustainable dividend yield that aligns with or slightly exceeds industry average to attract income-focused investor. Lastly is flexibility in dividend policy. It is adjusting dividend based on performance and economic condition to maintain cash flow and business sustainability. For the conclusion, first is strong financial position with a balanced mix of equity and debt, low financial risk. Second is stable dividend policy with a 32% increase and a 35% payout ratio, demonstrating financial confidence. Third is dividend policy attract investor based on signaling and bird-in-hand theories. Fourth is suggest using hybrid instrument to lower cost of capital and maintain financial flexibility. Fifth is continue balancing stability, growth, and shareholder returns. How do companies make decisions regarding their capital structure and dividend policy, and what the current practices are they employing to optimize their financial performance? In terms of capital structure decision, first is balance debt and equity to minimize WACC and cost. Second is consider risk, flexibility, tax benefits, and market condition. In terms of dividend policy, we need to focus on cash flow and profitability to decide on payout. In terms of current practices, first is low debt due to rising interest rates and uncertainty. Second, issue convertible bonds, preferred share, and green bonds for flexibility and sustainability. Example, Tesla reduced debt and issued equity to reduce risk and support goals.
Alright, for research question, the question is, alright, so for the factors influencing capital structure, for industry, capital-intensive industries use more debt. Next, company size. Startups use equity. Mature firms use more debt. Other than that, economic conditions. High interest rates push firms toward equity. And lastly, profitability, stable earnings allow higher debt. Moving on to the next is impact of the recent economic condition. So, rising interest rates, company reduce debt issuance or refinance to lock in lower rates. And lastly, economic uncertainty led to more conservative capital structures. For example of the companies is Meta. It issued corporate bonds in 2022 to diversify funding while rates were lower. Next is Ford company. It reduced debt by focusing on cash flow. Next question is, alright, so for the factors influencing dividend policies is profitability. Higher profits support higher dividends. Next is growth opportunities. Growth companies return earnings. Next is cash flow. Sufficient cash flow enable stable payouts. And lastly, investor preferences. Income investors prefer stable dividends. Next, types of dividend policies. First is stable, consistent payouts. Next is residual, paid after funding investments. Other than that, constant payout ratio, fixed percentage of income. And lastly, hybrid, combines stability and flexibility. So, for the example of the companies is Apple. It increased dividends while maintaining share repurchases. Next is Disney company. It suspended dividends during the pandemic, partially reinstated in 2023. Alright, so we have come to the last question. And the question sounds like this. Alright, so for balancing growth and dividends, the companies reinvesting profits. High growth companies reinvest in expansions rather than paying high dividends. Next is balanced approach. Companies pay dividends while retain earnings for future growth. The example of the companies is Apple. It increased dividend and share repurchases, balancing growth and shareholder returns. And the next company is Ford. It reduced debt and focused on cash flow, balancing investment and also dividend. The strategy is both companies optimize capital structure and align dividends with growth to ensure long-term stability and meet shareholders' expectations.